The stock market is one of the most powerful tools for real-world wealth creation, but it can be confusing to learn about using a textbook, classroom, or complicated YouTube video. If you agree, then let's learn about the stock market using Minecraft. So first, what's a market? A market is simply a medium of exchange, meaning that it's a place where people can buy and sell things. Like if you bake a cake and you want to sell it, you might go to the cake market, where people go specifically to buy cakes. Markets are useful because they connect buyers and sellers. Markets can also implement rules and regulations to protect the buyers and sellers, such as requiring all sellers to undergo a background check to make sure they're not scam artists, or hiring security to prevent any theft of the seller's goods. Now that we've covered what a market is, what's a stock? Put simply, stocks are ownership in a company. Now to the unassumed, that might sound confusing. You didn't start the company, and you haven't made any important decisions. How can you buy ownership? The answer is through stocks. When first starting a company, the founder will likely take out some kind of loan in order to cover various startup expenses, such as real estate, capital, inventory, and so on. When a company begins to grow, however, the executives, or the people in charge, may decide to go public. This means that the company in question will sell off equity in the form of shares in return for money. Now, if you watched shows like Shark Tank, the term equity may sound familiar.
Sharks, I'm seeking $50,000 in exchange for 10% of my company. I'm 10 years old, but when I was
$50,000 is not a small amount of money. I'm here to make money.
Or something similar to that. Equity is ownership in a company, and stocks are a form of equity. When a company makes any profit, it is divided between equity holders based upon the percentage of equity they hold in a company. For example, if two individuals each hold 50% equity in a company, they would split the profits equally and both would have equal decision-making power. The more people who hold equity in the company, the more the profit is divided out and the less decision-making power a single person has. Now imagine this. 50,000 people decide they all want to buy equity, but in minuscule amounts, like 0.0054% or 0.0461%, all different and all very small. I'm sure you can imagine how convoluted the situation could get when calculating costs, deciding who gets what, and what's even available to buy. In order to avoid this hot mess, the stock exchange will act as a medium between businesses and interested investors. The stock exchange is like the cake market, but instead of cakes, it's stocks that people are buying and selling. The sellers and companies who are selling shares or ownership in their company, and buyers are investors who believe that the value of the shares will go up in the future. When a company wants to go public and enter an exchange, after meeting certain conditions of course, a price for the stock called an initial public offering or IPO will be created based on its current valuation, how much it's worth, and then divided by the amount of equity they want to sell, resulting in the outstanding shares or the total amount of shares available on the market. Supply and demand will then influence the stock price as time moves forward. If there are more people who want to buy stock in a cake company than there are available shares, then the price of the shares will go up. And if there are more shares than there are investors willing to buy shares, then the price will go down. It might seem like a bad deal on behalf of the company, selling out ownership to random people. However, there are specific benefits for a company who chooses to do so. For example, selling equity in the form of shares raises money that can be used to launch new projects, build new factories or warehouses, increase marketing, and overall be used to increase total revenue. This makes the equity overall more valuable in the long run. Selling shares is a great way for businesses to raise money without having to pay interest on conventional loans or deal with pesky private investors who can seriously influence a company's decisions. Influence is one major drawback on behalf of a company seeking to sell shares. Equity does not just dictate how profits are divided, but also what decisions are made and what direction a company goes. While this is not always a bona fide idea, typically the more equity one holds in a company, the more say they get in the company. Obviously, the board of directors, or the people in charge, are not going to consult every single shareholder for every decision they make. But investors as a whole will have a significant impact on a company's performance, Even if a company makes a decision which in the long run will be beneficial, but investors aren't happy, or perceive, even incorrectly, that the decision was a bad one, it can negatively affect the stock price and outlook, further affecting the company's bottom line. So let's put all of that information into a hypothetical scenario. Pork Chop Incorporated is a company that specializes in, you guessed it, sugar production. Right now, Pork Chop is a private company, meaning that 100% of the equity is owned by the owner. The owner only has one chunk of land to grow sugarcane, and decides that they want to grow their business by buying more land. The owner goes to a bank, but decides that the interest they would have to pay on a loan would be too great. Instead, the owner hires an investment banker to help Pork Chop Inc. issue their new shares. The company is then analyzed by the SEC, or the Security Exchange Commission, which is a bureaucratic agency responsible for making sure that companies are legit. The SEC will observe Pork Chop's management qualifications, their assets, their debt, their operations, and so on, to ensure that a company is viable to trade in the stock exchange. This is why a 6-year-old cannot sell shares on their lemonade stand, at least not on the official stock exchange. If Pork Chop gets approved by the SEC, they will then set an IPO date for when shares will be available, and the investment banker will create an advertisement for the company, which details their assets, operating information, and expected future growth. This advertisement is called a prospectus, which is then taken by the investment banker and given to a bunch of investors to generate interest in Pork Chop Inc. Once this is done, the investors will return indications of interest, which informs the owner of how many shares people will want to buy. Once this is done, the owner will take that amount of equity they wish to turn into shares, let's say in this case it's 50%, and then take the value of that equity divided by the number of shares the indications of interest inform that are desired in the stock exchange to get the stock price. So if Pork Chop has a total valuation of 200 emeralds and 50 investors indicate that they each want to buy one share of Pork Chop Inc., then the owner will take 50% of the total valuation, which would end up being 100 emeralds, and divide that by the 50 shares they plan to sell on the market, giving each share a value of 2 emeralds. Fast forward to the day of the IPO issuing. On the first day that shares for Pork Chop will be available, the company and executives of Pork Chop will ring the NYSE bell as a way to mark their achievement, and the public will now be able to trade shares of Pork Chop. Now all the investors that were interested in Pork Chop buy the 50 shares, giving the owner of Pork Chop 100 emeralds to invest and grow the business. Let's say that these 100 emeralds were used to create a new automatic sugarcane farm, which triples the amount of sugar that Pork Chop is able to produce. When news of this reaches the market, shares of Pork Chop skyrocket from 2 emeralds each to 5 emeralds, netting the initial investors a profit of 150% should they choose to sell. That's how people make money in the stock market, by investing in companies which innovate and invent new technologies and products to increase productivity and profits. But let's look at a different scenario. Let's say instead of a new automatic sugarcane farm, the owner decides to use the 100 emeralds to buy more farmland. This does increase sugar production, and the stock price does increase because of this. However, soon after the purchase, a massive drought ruins all of the sugarcane crop, and the price drops to 1 coal a share. The investors lose 90% of their money, and Pork Chop soon files for bankruptcy. This is the inherent risk that comes with investing in companies, as there are many factors which could negatively impact a company. These factors can be external, such as natural disasters, competition, or legislation, or internal, such as bad management, fraud, and ineffective operations. Now let's look at a third scenario. The owner decides to buy the land instead of the machine, but there's no drought. Business goes up, and the company grows. Except Pork Chop's biggest competitor, Mutton Chops, invents the automatic sugarcane farm instead, which pulls investors and customers away from Pork Chop. Pork Chop is still operating fine, but the shares of Mutton Chop are increasing much greater than those of pork chop. This is called opportunity cost, and it's the theoretical loss of profit one suffers by investing in a less lucrative investment. An investor might only have 100 emeralds to invest in total, and by buying shares of pork chop instead of mutton chop, they're losing out on, let's say, a 10% gain, or 10 emeralds. You also have to be aware of taxes and inflation, which also diminish your potential gains as an investor. This causes investors to act very irrationally, and involves many psychological factors which I'll cover in another video. Now you have a basic idea of how the stock market works, how businesses enter the stock exchange, and how investors make money. If you learned something and want more Stonks101 videos, please like and subscribe. My channel is new and your support helps more than you know. Have a great day.